All those ones you mentioned are filed for spot ETFs. We think most of them have a greater than 50% chance of getting approved under this SEC based on the actions we've seen so far this year. And ironically, really even just in the last week or two, it's been
Mm.
rather aggressive.
This episode is brought to you by Uphold, which is a great crypto platform that I've been using since 2018. Uphold makes it easy to buy, sell, trade cryptocurrencies like Bitcoin and altcoins. In fact, they have 300 plus cryptocurrencies on their platform, and they carry precious metals such as gold and silver, and you can swap between these assets. So it's really unique. Uphold is safe and reliable. I've never had any issues with them, and they are 100% reserved. You can review their transparency report. They don't commingle or lend out your funds. Now, Uphold recently launched a great product called Uphold Rewards, and it's packed with many benefits. You can earn up to 5.25% on stablecoins, get 24-hour early access to new token listings, and unlock exclusive crypto insights. And they support a variety of stablecoins, such as PYUSD, that's PayPal stablecoin, Circle's USDC, and USBC. They will be supporting Ripple's upcoming launch of RLUSD. So this is a really great rewards program. And if you'd like to learn more, please visit the link in the description. Welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and my guest today is James Seyffart, who's an ETF research analyst at Bloomberg. James, good to see you. Happy Friday.
What's going on, Tony? Happy Friday. Thanks for having me.
James, I had to get you on because we got very big news happening in the ETF space around altcoins and even BlackRock's Bitcoin ETF. I would love to start with the news that broke this morning of the CME Group launching Solana Futures. You and I have spoken in the past that the futures market is important for a spot ETF to get approved. What are your thoughts on this launch?
Yeah, so Coinbase also did it already. So CME is going to do it. CME is the one that like everyone has used historically. So it's big news. Historically, it was required to get an ETF launch. My take for a while now has for a spot ETF to launch, you don't even need the futures market. I really don't think you needed. That was just like something from the old administration, the Gary Gensler administration. They set up this arbitrary rule that you needed a derivatives market or futures market to surveil in order to launch an ETF. It's been my view, even from when the Bitcoin ETFs were approved, that really wasn't that necessary. You could set up surveillance sharing agreements with the likes of Coinbase and Gemini and Kraken and Binance, you name it, right? And that should have been enough to satisfy their surveillance questions. The problem is Gensler didn't want to give them any legitimacy, I think. So I think they leaned on the derivatives market specifically because they didn't want to bring legitimacy to those exchanges. And we saw that via the Wells notices they filed, the investigations they filed into all these things, and the actual lawsuits they filed against Coinbase and Kraken and you name it, right? So I think now that all that's going to be unwind, I don't think we needed this in order to get a spot Solana ETF or spot anything ETF, but it's obviously a very positive sign, as is everything that's been happening over the last few weeks in the crypto space with relation to the SEC and the government. The only thing that hasn't been positive, ironically enough, has been the price and the whole ecosystem. So, but yeah.
Yeah, and to your point, I remember interviewing Hester Peirce a couple of months ago, and I asked her about this. She wouldn't answer directly, and maybe she's waiting on Paul Atkins, the new chair, to come in and they decide what they want to do. My hope is they don't continue, to your point, that they need the futures because it's so arbitrary. But nevertheless, I think a good sign and maybe healthy balance for the market, right? You have the futures and then you have a spot. Maybe that's good overall.
Yeah, no, I think it is healthy. And then the other part of it is the fact that the SEC is allowing these things to list with the CFTC, which they've already done with Coinbase, as I mentioned, as CME is going to do. They're going to be listed as traditional futures contracts. So that is basically a nod that these things are commodities in the SEC's view. Obviously, nothing is like 100% in concrete, but the fact that these things are listing as traditional futures contracts means that they're likely going to not be viewed as securities, which we kind of gathered in the fact that, the SEC is dropping these cases, or at least starting the process of dropping many cases into these exchanges who trade these different tokens, including Solana and different things like that. So I think this is just more indication that they're leaning towards most of these things are commodities, most likely. Some of them are going to be securities, but yeah.
Now, in addition to Solana, there's other ETF filings for altcoins such as Hbar, Litecoin, Dogecoin. Our friends at Bitwise filed for that one. And then XRP, of course. I think I saw tweets from you and Eric Balchunas about which ones had the likelihood of getting passed, maybe like Litecoin or Hbar. Correct me if I'm wrong there.
Yeah. So we had Litecoin at the highest odds at like 90%, mostly because I've talked about this on your show before. There, in order to get an ETF approved, there's like a billion different things that need to happen. So that right, so that everyone can like issue these press releases like breaking news, this happened, and it's like, yeah, this is step one of like 500,000 essentially, right?
Right.
So there's a lot of things that can happen. But what is happening with Litecoin, the real thing is you need two different divisions of the SEC to approve these things, right? So one is through the Division of Trading and Markets, and one of them is through the Division of Corporate Finance. What we're seeing with Litecoin and potentially even Hbar, we don't know if it's mostly because Canary, the issuer that followed for both of those, is working a different path with the SEC, or if it's because those assets are different in the sense that they weren't in those lawsuits being called securities.
Yeah.
So, but we have seen movement on that Corp Fin side, we think, and we're definitely seeing movement on the Division of Trading Market side in those 19 before orders. So all those ones you mentioned are filed for spot ETFs. We think most of them have a greater than 50% chance of getting approved under this SEC based on the actions we've seen so far this year. And ironically, really even just in the last week or two, it's been rather aggressive that the SEC is in the where the SEC is heading. So our odds are north of 50%, but Litecoin is the highest. Doge also seems fairly likely because there was never really any question whether or not that was a security or not. Hbar, not as clear in my mind as Litecoin and Dogecoin, but I think it's also in the same camp. And like I said, Solana, XRP, Cardano, Polkadot, these things, I just don't know that the SEC is going to go after and call them securities and not let them the list in a commodities ETF wrapper. I really don't think that's going to be the case.
And in addition to, you mentioned it, the cases that are being dropped, a lot of these coins were named in there. With these lawsuits out of the way, there's no uncertainty hanging over us, no dark cloud of, oh, Cardano, XRP, Solana, these are securities because they're mentioned in the Robinhood or the Coinbase case or the Kraken case and things like that.
100%. Yeah. So they're literally blatantly stated, you are listing these securities, and that's why you're operating an unregistered securities exchange. And Solana and Cardano and some of these other ones are like blatantly listed in there, right? XRP is a little different because they have, the direct lawsuit between Ripple and the SEC that'll likely need to be sorted before we can see an ETF on there. I think it's also a little different in the sense that I don't know that it's going to be like fully dropped in the way that some of these other ones are.
Right.
There's probably going to be some sort of settlement. I don't know. Who knows how it's actually going to play out. But I think it's a little bit more complicated just because that lawsuit has been going on for so long. And they won some parts of it. They lost some parts of it. Different parts of it have been appealed. It's a little more complicated, right? But I do think eventually we're going to see an XRP ETF as well. Yeah.
Question for you on the XRP ETF. And once again, the future is not really required, but are there XRP futures already in the market?
Yeah, I'm not sure. I don't think there are XRP futures yet. But I wouldn't be surprised if we see them soon as well. I will say we're talking about like these spot products, and these spot products are the ETFs that hold these things that are going to be the most successful in the US at least. There's also a bunch of products that are going to hold futures and derivatives and different ways to get exposure that they'll probably come first, it looks like, potentially. So the first one that would come due is a Solana Futures ETF, and that could launch as early as like mid-March potentially if the SEC really like lets things go. As you mentioned, we're going to see these futures list, and theoretically it could list as early as mid-March. That said, it could take much longer for the spot products. There's no way to know exactly how long the SEC is going to take. The final deadlines for a bunch of these, like the ones we talked about before, Litecoin, the final deadline is October 2nd. Solana, XRP, Dogecoin are like October 10th, October 17th, Cardano, October 28th. So like the final deadlines are there. And under the prior SEC admin, and honestly, even before the prior SEC admin, they usually waited till the final deadline to approve these things. But I think maybe Litecoin, as we mentioned, Dogecoin, Hbar, there's not as much like legal complexity around them, so they could theoretically come out before the other ones. But we're pretty confident that we think these things are going to launch at some point in 2025, and I think some of them even have a good chance of being approved by the SEC before their final deadlines.
Yeah, it'd be cool if they were able to approve them sooner than later versus later in the year of October or Q4 and things like that. But we'll have to wait and see. Maybe they wait for Paul Atkins to come into office before doing that. and finalize a few things on that front before, because the ETFs are such a big thing. Dropping a case that got or a Wells notice, not really a big deal, but approving some of these ETFs where there's complications, they may want to wait for the chair, but we'll have to wait and see.
Yeah, exactly. Dropping those Wells notices, not the biggest thing in the world, but it's more an indication of what's to come that matters. And the other thing I would say is the Ethereum ETFs were dwarfed by the launch of the Bitcoin ETFs. And we also think that like a lot of these other ETFs, these altcoin ETFs, they're just not going to see the same level of interest. I think some people are out there think we're going to see like the same type of inflows that we saw to the Bitcoin products, and that's very unlikely to be the case for all these altcoin ETFs. The ones that might actually get significant interest over the coming years are some of these ones. There's a bunch of index funds that have recently launched. They only hold Bitcoin and ETH right now, but they're trying to add these other tokens we just talked about. There's some other processes to Bitwise has an index fund of crypto that is a closed-end trust essentially right now, like those Grayscale trusts used to be. Grayscale also has one, GDLC. So like I think those things could be of interest to the typical ETF user. But a lot of these single asset altcoin ETFs, I think they'll be successful. It's just like people need to understand that they're not going to get,
Yeah.
$40 billion of inflows in year one in the way that the Bitcoin ETFs did.
Yeah, great point. And on the topic of Ethereum ETFs, the SEC has been having a lot of conversations about staking, and there's people, filing to have staking added to the ETH ETFs like Grayscale and so forth. Do you think we see approval of that soon? And could that bring in more inflows into ETH because you have the yield?
So one, I do think those are going to be approved this year as well. There's some things that need to be ironed out. Like Hester has done a lot of work to write these, like a lot of questions about how this should be handled in the space. There are filings out there, like you just talked about. The final deadline for the first one on Ethereum staking, I believe, is sometime towards the end of October. So that will definitely potentially, like that's one of the things that I think hindered the launch of the Ethereum ETF interest, because you're basically, giving up potential yield to put it in an ETF wrapper. So like if you're taking something and it's less efficient and lower return, lower yield than if you didn't put in that wrapper, it's kind of the only reason you would do it is the only way you can get access to that asset is in that wrapper, aka the ETF. So I think that hinders some of the demand for Ethereum ETFs. But the other thing I would say is a lot of people think because the Ethereum ETFs did not do very well at all when they launched, right? They had net outflows for many months, but after Trump had his election victory, they swung from $600-ish million in outflows on a net basis from all the ETFs to over 3 billion in inflows. So
Mhm.
they've also had tremendous success. The only problem is they have less than 10 billion in assets, despite the fact that they launched with like 10 billion in assets in July. So they've taken in a ton of money. It's just that the price of ETH has gone down so bad that they actually have less in assets than they did when they started, which is both funny and interesting, a little sad maybe. But yeah, there's definitely interest in all of these things, and I think staking would obviously bring a little bit more interest here. Because like I said, you're kind of neutering the asset by putting it in a wrapper where you can't actually do any sort of DeFi or staking.
Yeah, absolutely. So hopefully just like with the other altcoin ETFs, the SEC approves these things sooner than later. It'd be really good. And I think we'll bring in a lot of inflows and a lot of interest in the market. Now, this morning, we got news of BlackRock adding 1 to 2% of their Bitcoin ETF IBIT allocation to their model portfolios to allow for alternatives. Tell us about this. What are they trying to achieve here?
Yeah, so I've got a lot of questions today from people asking like, what does this even mean? Like, what is a model portfolio? And what you need to realize is a lot of these asset management firms, they create models, and what they do is they basically say this percent goes to this bucket, equities, fixed income, alternatives, what have you. And these are the ETFs we're using in different proportions. And the people who track those models, there's a few different options. Either A, you just have a thing that's automated and it automatically does whatever those models are doing. There's platforms that do this for you. A lot of advisors will like look at the models and like make tweaks of their own. Maybe they don't buy the exact ETFs that they're putting in there. They might swap it out. So in the case of IBIT, in this case we're talking about here, they might like buy another ETF, whether it's Fidelity or Bitwise or VanEck or something like that, right? For whatever reason. But for the most part, in many cases, it's like these are suggestions from the BlackRock model, and this is what we're going to do. This model is not nowhere near their biggest model. Like they have some models that have serious money that tracks them, or at least follows them, is a better way to say it.
Hmm.
So this is one that's specifically set up to hold a decent amount of alternatives in the model. And so what this is doing is basically taking, and they're saying they're going to, in this model that specifically is for advisors and clients that are interested in alternatives in their portfolio, and they're putting like a 1% allocation. And I mean, it's not that big of a deal, like I said, because it's a relatively small model, but it is meaningful in the sense that this is the first time BlackRock is officially doing this. And it could be indicative of what they're going to do down the line in other models, but you got to also realize like Bitcoin is a lightning rod topic. So
Hmm.
there are a lot of people that really hate it and do not want it in the portfolio.
Yeah.
And there are people who are on the opposite side, obviously, as you're very much aware. So they're going to take their time putting these things into models and making sure they don't, annoy too many of their customers. But as I said, for the most part, if you're in one of these models, you don't have to have it set up where you just do exactly that everything that BlackRock recommends. For the most part, it's advisors that use these models, and they're free usually once you subscribe to them, because the benefit for them is like they're creating these models, they're giving you this like asset allocation model for free, but the ETFs they're recommending are their own ETFs. So that's how they end up making money in the long run by doing this.
Right. Dumb question I'm going to ask you here. So with the allocation, is it, and I hope I can articulate this well. Let's say there's one road leading into the Bitcoin ETF that BlackRock offers, right? The capital is coming in this way. But if they allocate it to different index funds or whatever it is capital coming in into each of those funds going into the ETF in addition to the other products in that index fund?
Yeah, so it's not an actual fund. It's just like, so the
Okay.
model is like it's like it might have a mutual fund in there, it might have ETFs in there. So like say you want large cap equity, it's going to say you should have that 20% of your portfolio US large cap, and then some other percent will be like large diversified developed international, and then some certain percentage is going to be another ETF to give you emerging market equity exposure. Some will be treasury bond exposure. So in this case, they just took 1% of that entire portfolio and one ticker and a tiny bit, and they put it in these different models that are specifically set up to hold a decent amount of alternatives in them. There's plenty of models where like we're just going to give you models for your equity exposure. We're just going to give you models for fixed income. We're just going to give you models for a 60-40 type approach for
Mm.
equity and fixed income, right? So this is just like, this is what we would do. This is the allocations we would have. And then they send it out to everyone who follows those models and tracks them. And they can either do exactly what the models are suggesting, or they can wait longer or do something different.
Got it. Okay, that makes sense. Final item here before I let you go. We've seen some outflows out of these ETFs, whether it be Fidelity, BlackRock, and much more. Obviously, you're going to see rebalancing of the portfolio. People are going to take profits, customers, and so on and so forth. Do you expect this to rebound though, as the price of Bitcoin rebounds, hopefully in another month?
Yeah. I mean, the thing here is like we've seen over $3 billion in outflows since February 10th. So that's just about 2 weeks, right? That's a lot of money coming out. But what you got to also realize is like, one, this is a very volatile asset. Anyone listening to this knows that it's had many multiple 70 to 80% drawdowns. And the other part of it is uh like these ETFs had like 114-ish billion dollars in assets before this drawdown of outflows started. So yes, it's a lot of money coming out, but also it's like 3-ish% of the ETFs.
Right.
And the way ETFs grow, like they are built to have inflows and outflows. They are structurally efficient in the sense that they're going to track the underlying assets. So as demand falls for these ETFs, they're going to see outflows. As demand rises, they'll see inflows. And the way an ETF category grows is it's going to be, a couple steps forward, maybe a step back. Like it's always going to be inflows, and then at some point there's going to be outflows. Yes, this is the record now for the most outflows we've seen in this category, but it's grown to $100+ billion in assets, right? So
Yeah.
you're going to see meaningful outflows, particularly when you see 20+% drawdowns. I mean, theoretically, maybe there's going to be some dip buying. I wouldn't be surprised to see there will be people might be rebalancing their portfolios. Those model portfolios I was talking about, usually the way they set up in their portfolio allocations is like they'll rebalance quarterly, but if like something drops a significant amount, there might be triggers to be like, all right, we're going to do a rebalance because I don't know, US large cap is down 7% in a month. We're going to rebalance into it. Or in this case, Bitcoin's down 20+%. but it's such a small allocation in that BlackRock model we were talking about that yeah, there's not much happening there right now. It's like I said, it's basically BlackRock dipping their toe in the water. Probably going to be looking for feedback from their end clients and see how that goes, because these are the people that are most likely to be most amenable to, a Bitcoin ETF in their model portfolio, because they want more alternatives. They don't just want stocks and bonds, the people that are tracking those models. So yeah, I think the ETFs will be just fine. Like I said, they're built to have inflows and outflows.
Yeah.
The way a category grows is by going up and then seeing outflows and so on. Like if everything went straight up and to the right, you wouldn't be rewarded with the returns that you're rewarded with in many cases in these volatile assets. And I think that's the same way to think about these Bitcoin flows. It's par for the course.
Yeah, absolutely. I know I told you last question, but something just popped into mind, and I want to get your perspective on it, given that you're at Bloomberg and you hear and see things that a lot of people don't. We're seeing a bit of a narrative change from a lot of Wall Street. Just this past week, Citadel Securities, they said they're going to get involved in crypto. Bank of America's CEO says they want to launch a stable coin. Are you seeing a tone shift? People being more comfortable given that the government is more pro crypto now?
Yeah, I definitely seeing it. I mean, so I'll go back to like in 2017 through like 2024, there's a bunch of different advisors and platforms did surveys and basically like, are you interested in allocating to this space? Yes, no, why? And almost the vast majority of the respondents that said not yet, or like they were thinking about it, but they won't do it. The reasons why they wouldn't do it were, one, the regulatory concerns and the government, right? They weren't concerned. They weren't regulated. They were about the risks of that. And the other thing was there was no like structure or wrapper for them to get exposure to it in a way they felt comfortable. And in the last year, we've satisfied both of those two major headwinds in the sense that the government is now on board and providing clarity in a regulatory sense. And also now we have the ETFs. So that from the advisor perspective is big. And then also you see corporations like the ones you just mentioned that were like, they didn't want to touch this stuff because for the most part, the SEC, the FDIC, you name it, the whole host of different government agencies were very hostile to the space and it just wasn't worth doing anything. So even if they were building things or testing things in the background, as is very likely what happened based on how quickly things seem to be moving from these different people, including Bank of America, they just weren't going to do it until there was more, regulatory clarity and it wasn't such a political overhang. So I think that's all you're seeing right now. You're seeing an unwinding of those headwinds that we've been used to. And that's why people are coming to the space. And it's a good thing. I mean, it never should have been like that. I hope we don't swing too far to the other side. Everyone's joking about crime season and whatnot. So I hope we don't swing too far to the other side. I hope the industry polices itself. But yeah, the way things were working in the past, just it didn't make sense to a whole host of people. And I hope the industry learns from it.
For sure. And to your point, as we wrap it up, I hope the meme coin market dries up. To your point, there's too much abuse of that, man. It's crazy. I'm hoping this silver lining of this massive correction is the bleeding out of these meme coins.
Yeah, I agree with you. I mean, they're fun. It's gambling. You should know what you're getting yourself involved in, but it's also very predatory. It's almost like institutionalized, like predation of like retail people trying to trade these meme coins based on some of the stuff that's come out with the Memecoins. And, we saw Melania and Trump and all these different things that have come out. It just, yeah, it just doesn't sit right with me as somebody who like is a more tradfi type of person, particularly. But even if I try to say like, you're gambling, it's still just, they're not going away. I don't think they're going to go to nothing.
Right.
I just think that it's going to be vastly, vastly diminished, and I think that's the right way it should be. I hope, and honestly, we talked about like lack of regulatory clarity. Like one of the only things we did have remote clarity on was the fact that these meme coins, they have no utility, they have no reason to do anything. They're basically just speculation and gambling. Those were the only things the SEC wasn't stopping. So like anyone who wanted to build something with utility or that had some sort of structure, though the SEC was attacking them, but they were just letting these meme coins go. It was just, it just didn't look right to me. And I hope we get back to more, building things that have actual utility and use. Yeah. So I echo your concerns.
You know what it made me think of? Jordan Belfort, Wolf of Wall Street, the penny stocks, the boiler room guys, right? It's this
Yeah.
era's version of it.
Yeah. I mean, you see some of the stuff of these people that were involved like in the trenches and behind the scenes of like launching some of these things. And it's like some of the stuff you're saying is like illegal. Like
Yeah,
I'm not a lawyer, allegedly, whatever you have to say, but some of it is like I can't believe these people were saying these things on the record. It's like that scene from The Big Short where where he's like, why are these guys confessing? And they look at Steve Carell and they go, they're not confessing, they're bragging.
bragging.
Like
Yeah,
yeah, like people like think like it's crazy. I don't know. I'm
it's wild.
so that's the thing. A lot of people are like, oh, the SEC is not going to go soft on this stuff, right? They're going to stop going after the good actors in what we talked about earlier. And I hope they ramp up the stuff in the people committing fraud and manipulation and things like that. So yeah, I'm
Absolutely.
optimistic for the space, and I think that we're heading in the right direction as far as regulatory concerns go, as far as what's allowed in an ETF wrapper. We'll see some of that this year. But yeah, I'm optimistic.
Yeah, for sure. James, always great stuff, my friend. Thank you so much for joining me.
Yeah, thanks for having me, Tony.